Hey M&A scientists, we all know that tracking progress in M&A is crucial. But let's be honest, manually creating reports is a time-consuming headache. Nobody wants to spend 10 to 15 hours a week dumping data into Excel and crafting PowerPoint slides. That's where Dealroom BI comes in. Dealroom BI automates all your M&A reporting completely. We're talking about pipeline reports, showing where every deal is at, what stage they're in, and timelines. Need a full diligence readout? Done. Want to track integration progress against milestones and synergies? Dealroom BI has you covered. You can even schedule these reports to be emailed out automatically on a weekly basis. Imagine reclaiming all that time you spend on manual reporting, put that analyst back on sourcing the next big deal, and let Dealroom BI handle the rest. If you're tired of wasting time and want to streamline your M&A process, check out Dealroom BI. Visit dealroom.net to learn more. Trust me, it's going to save you a lot of time and headaches. Here's to the deal. Welcome back to the M&A Science Podcast. I'm your host, Kisan Patel. Today we're back for the second part of our two-part interview with Dr. Amit Monga, founder and CEO of SARAPOINT. If you haven't listened to part one yet, I encourage you to check it out below in the show notes before starting today's episode. In the second part today, we're shifting gears to explore software valuation trends and the challenges of structuring carve-outs and strategies for managing deals with difficult CEOs. Let's jump into part two. So I got to ask you, in software, I'm almost seeing this trend of going from the EBITDA multiplier to just revenue multiplier. What are your thoughts on that?
It's a combination. It's a combination now. To be honest with you, it's a combination. It has to pass the smell test for the margin profiles at the gross margin level, at the OpEx level, at the net income level, at the EBITDA level, and then from that point onwards. The reason you sometimes jump into an EV to sales kind of multiple or price to sales multiple is because you're still investing in growth, right? So at that point, you got to say, like, am I getting the return on my investment dollars, right? It's like that's the part people start kind of, missing because, okay, well, I launched a new product. Excellent. That's the reason I'm not profitable this year. Okay. When did you launch the product? I launched it at end of Q1, calendar Q1 of this year. Well, we are 1 year out. How many of them have you sold? Right? Like you need to start kind of saying, is the execution working or is it not working?
Right.
The other ones I've seen, and this is like, I roll my eyes like, oh, we're growing 50%, 100% year over year. How much of that is organic? Oh, no, we were just acquiring companies.
Well,
okay.
You see that a lot, both like public and private.
Yeah. And it's like, guys, like, have you integrated them? No, we have not integrated them. Like, we just like, well, just by going on their website, you have competing products. Like, it's like, yeah, we just haven't had a chance to kind of, look into that stuff. So you see that as well. So I'm not going to give you a premium multiple on sales if all your growth is inorganic. Now, if you are like, it's word of mouth, like, you land and expand like crazy, I'll give you that multiple. I'll give you that premium multiple, and I will inform that with all other metrics in your space, kind of a thing.
It gets blurry when a company's acquisitive because a lot of times there isn't that transparency of what business lines are organic growth and the newly acquired. Do you get to that?
You have to model it sometimes. Like, I mean, of course, like, I think this is where if you have an advisor, you basically can go to the banker and say, hey, listen, I need to understand like why is this company so profitable all of a sudden? Guess what? I've seen softwares where, we actually have added payments as part of this. So now we get 2.5% of transaction fee and it's all going to the bottom line. Oh, okay. So wait a minute. Yeah, you're right. Your customer base is shrinking. You've just added this piece, and it looks it looks as if you're growing more profitably now and so on, but your overall strategy is actually not stable right now.
Yeah.
So it's like, okay, I'll take that piece out. Tell me, like, how are you going to add more logos? How are you going to expand? Like, have you like maxed out your TAM? Like, you know what I mean? Like, is it like there's only, X percentage of companies that will use your software? Have you gotten all of them now? Like, so you have to start looking at that stuff.
Devil's in the details. I think the thing we really distinguish is the mindset between venture capital and private equity. Because when I talk about just pure revenue-based investments, it's pretty much a VC mindset.
Yes.
It's like they want to see some key metrics in terms of the growth and those factors. But like private equity, there's so much around the bottom line profitability. And a lot of time the EBITDA is even a bigger factor, especially as you go upstream. And that's when you start getting into some of these scenarios where you're doing some artificial things to drive those margins up.
Exactly. I mean, listen, I think VCs have done a great job in terms of funding innovation. Like, I think without that asset class, you won't have some great
hopeful
company.
Investments have done a lot of great things for this country.
Exactly. But I think it's at the end of the day, if you're looking at a long-term viability of a company, you need to kind of figure out how do you run it profitably kind of, over time. And I think it's very important to kind of differentiate that early on in the process. So I think you don't have to worry about, profitability, obviously at the seed stage or Series A stage or Series B. But the moment you're moving towards the next round, which could be a growth round for the company where the cap table is being cleaned up, as in like the early investors are getting out at a 10x or a 5x or in less than 10 years or whatever the time frame is. Anyone who comes in now wants to see the financial viability of this company as a standalone kind of company without raising extra cash for funding their existing operations. Now, you may need to raise cash to acquire companies or fund other growth initiatives, but it's like on a steady state now, can it survive? Because the risk capital has done its part and now you're here.
I thought those days are gone of actually buying a business that can stand on its own. After the deal's done, you've stacked enough debt on it.
Yeah. I mean, the good thing is the people who are providing debt, they do their own homework, right? They look at their company's ability to pay the interest and, pay down the debt and things like that. So it's actually nice to kind of have debt on the table. Because that adds just another level of kind of, due diligence.
More diligence.
What you don't want to do is have a very, a debt with a very high kind of, interest rate or a coupon.
I was going to ask you, who's lending on software deals? Because one, it's software. I feel like traditional banks don't like doing those deals in general. They want hard assets. They want buildings and factories. But so one who does those, and I know we got this huge emerging sort of cash-based funds out there.
Yes.
Funds that lend on your cash flow at their high interest. They're all 16+%.
I think there's a category of what they call venture debt, which is upcoming kind of, asset class, if you will. And it's very, it's maturing now kind of a thing.
What are the rates on that?
Rates could be all over the place. It could be prime plus 2, 3, 4.
That's not too bad.
Yeah.
So prime plus is a good sign.
Yeah. And it again depends on the risk profile of the company, right? So that's the way you have to look at it. So the company has to have decent amount of equity on their balance sheet. And it has to at least what I've seen in software is recurring revenue piece. So you will get basically lent on a turn of recurring revenue, for example, because they can see that, the company can actually pay based on that recurring revenue piece. And then the equity piece has to be on top of that. But that market is kind of maturing in Canada for sure. I know in the US as well.
Versus bottom line, tax return figure.
Exactly. Yeah, because a lot of these companies at the early stage are still EBITDA kind of break even or negative, right? So if I can see the recurring revenue piece, if I can kind of, map that out, okay, this is over the next 12 months, 24 months, 36 months, depending on the end markets, depending on the sector, depending on the quality of revenues, depending on the size of the contracts and so on, and depending on what their balance sheet is. Like, so if you just raise $50 million and you have a decent recurring revenue base, you will be able to access debt as part of that.
The deals in terms of, you ever had to convince someone to sell their company?
Yes. So the situation was someone who was, without going into too much detail, a client of a bank, like, wealth management kind of a thing. And you basically sit down with them and say, listen, what's your succession plan? The longest time, like, the person was kind of grooming his kids to kind of take over the business. And then you kind of say, listen, they're not interested, right? One guy is like, doing this and the other person is doing that. Like, so we also believe that you don't want to miss the window, because what you don't want to happen is you slowly start to pulling back, and then it's actually value erosion, right? Yeah. So you want to do it when you're still in the game, like you're talking to customers, you're visiting them and stuff like that. So yes, like at that time, you basically say, listen, think of this from just personal wealth management perspective, and then also look at your age, right? Like, if you are at a point where you want to enjoy, like, this is when you have to do it. It's very tough because people always think like, if I could do another 5 more years, the value will be 100 million or 300 million or something like that. People don't want to leave money on the table.
The right time to sell. That's where you're selling on is this the right time to sell?
The best thing is actually, rather than trying to convince them, say, hey, this is where the trust model comes in. Do you give me the permission to just like casually socialize with some of these potential buyers of how much they will pay for the company? That's another way of kind of looking at it, right? Do I have your permission? And if you're the trusted advisor, it's like, Amit, you know what? Actually, go for it. Not even signing the engagement letter, because there's a level of trust. There's no kind of like, and then I say, you know what? Actually, I talked to 5 guys. 3 of them are like, we're willing to offer. Do I have your permission to now share the numbers? And at that point, you want to sign the letter. Yeah. Like, you're right. So now you've signed the letter. And what I want to do is just have a high level teaser with like just a high level kind of, numbers, and tell people like, hey, listen, why don't you give me IOI, indication of interest? Where would you land on something like this? And that's the other thing. It's not a spray and pray approach. This is not sending out 500 teasers. This is a very targeted approach to people you think will give the most value for the company. So that's another value an investment banker brings to it, like a target. You actually call it targeted outreach. Yep. A very targeted outreach, a combination of strategics, combination of private equity guys who may have a portfolio company, and it's a elegant tuck-in into that.
So it's a little bit of, hey, why don't we see what we come up with? Let's test the water. It's not a hard sell, like you got to sell, but let's just see what's out there.
Test the water, price discovery kind of a thing, right? And then it's like, like we thought this would be 175, like people are willing to put in 250. And it's like, oh, 250. Now you've really gotten my attention, and let's go.
Right time to sell is when you're on the up and up.
Yes, absolutely.
There's a range of an up and up. Right now, still bootstrap company pushing at 60% year-over-year growth, which is great.
That's yeah.
I talked to some of the venture-backed folks, and they're on the clock to go hit 100, 200% year-over-year.
Well, 20% of $1 billion is like different than
so that's what I was getting at. Was now you start looking at companies that's more realistic or typical. You're in the 10 to 25% bucket. You're in the 0%, the negative. How do you look at that growth percentage and the impact on valuation?
If you can continue to scale, grow at scale, I think that's great.
Like, so there's almost like, here's your year over year, but there's got to be some history to it to really give you more confidence, as opposed to like, okay, was that a fluke year?
Well, the thing is, like, you basically, it's very analytical. Like, I mean, you look at new customers added, right? So that's like new logos. Then for the existing logos, how much did you upsell? Maybe I just bought your M&A module. I was like, man, I really like this product. I'll take the funnel. I'll take the other one. That's huge for me, because like, you've created a stickiness here, even though I don't need this middle piece, which is going to be a transaction-based basis. Like, actually have these two pieces now. So net new logos, for example, the ability to kind of, add more, sell more, the same, like to your existing land and expand. All those things are very, very valuable. And they say a lot about, your execution strategy and so on. 20%, I think the table stakes are 20 to 30% at scale as well. At $1 billion, if you're growing at 20%, you're going to get premium valuation.
There's clicking in to understand the quality of the growth, which is the logo count and the increase of the retention revenue. And then the size matters. So if why would you tier those? I feel like we're just getting out of the 0 to 10 million mark, and then, you're sort of at the 10 to 30 million mark. And then there's what, like, I don't know. What's your definition?
Yeah, I think the first 10 is the hardest, in my opinion. Like, going from 5 to 10 is the hardest. But I think if you can get from 10 to 25, 25 to 50, you basically have like new set of entrants who are basically want your company.
I think so. I think at 20 is when it opens up the floodgates, this whole world of private equity. They look at you less of an acquisition target, more of a platform.
You got it. And I mean, and you can also flip that in an EBITDA term too, right? $1 million in EBITDA to $5 million in EBITDA to a $10 million in EBITDA. All of a sudden, I can lend you like 30 million, 3 times like, your EBITDA, and even like accelerate your growth, kind of a thing. So think of those kind of buckets. And it's absolutely fine in that growth strategy. Some of that growth is inorganic, because that also shows your ability to convince other players to become part of your family.
Yeah.
So a lot of times people are like, oh, but some of that is like inorganic. Are you going to discount that? No, I'm not. Like, I'm going to be very rational about it. I'm going to look at it. And I encourage people to do small tuck-ins as they are in the $10 million range, because it's like, you're starting to create, goes back to our internal kind of, like that muscle kind of memory, that there's a value for that team, right, over time, because if the PE guys are looking at it, they have like, we've been after this space for a long time, and I've got like 10 companies, but just don't have the right management to do the consolidation. It's like, well, actually, we've also know these companies. And by the way, Amit's my head of M&A. He's got 5 guys underneath. It's like, okay, great. Like, how would you roll this in? This is how we would roll this in. This is the one we would integrate. This one is in Germany. We would not integrate, stuff like that. And they're like, let's go. And actually at that point, they're going to say, you do have the ability to grow equally organically and inorganically.
What deal would you do? Like, if you're that company looking to do their first acquisition.
Yes.
What type of deal would you look for? I'd say like right now, I'm looking opportunistic, obviously, but then there's stuff where it's aggressive. It's like, can we pull the customers over and kill the product? Like, what would you do? What would you actually look for on that first deal? You're still in that strong growth, organic, and you're looking to do that. You're looking to prove yourself before you go out, hit 20 million ARR and start raising institutional money that, hey, M&A is a big appetite thing for us. We're taking this serious. What would you be looking for?
So actually, I mean, a real life example where the deal I suggested the same dilemma is like, I think it's time, Amit. Like, we need to start doing some acquisitions. Otherwise, like, it's boring. Like, our product is so good, and like, we need to do something more than what we are doing today. So I went to their salespeople. I was like, are you cross-selling with someone? He's like, yeah, I'm cross-selling with this platform. It was a telco company. I was like, okay, what do they do? It's like, yeah, they do this and they sell the solution, but as part of their sale, this is our equipment. I was like, okay, are they just pure sales? I said, no, they actually also have their proprietary front end. That is a UI and dashboard. So what's their business model? It's SaaS. It's SaaS? I said, okay, like how many people? It's like, well, bootstrap 15 guys. You guys know them well? Oh, we're best buddies. Like we 90% of the deals they've done, we're basically selling. I'm like, okay, great. So that's it. That's the intelligence I've got. My next internal meeting, I was like bringing the CEO and the CTO. I was like, this company? He said, yeah, I love those guys, man. Like we go out for beer after every, trade conference and stuff like that. I was like, you want to do your first acquisition? That's your first acquisition. I was like, wow, we never thought of that. Like, it was just great. It was seamless. Like all of a sudden, there's a telco equipment company, different gross margin profile. We bought a SaaS company.
Yeah.
And the markets are like, wow, this is amazing. Like you guys can do this. You're adding and seamless integration. Actually, they loved it because the guys were like, thank God we don't need to worry about payroll. Oh, you have an IT department because if the computer breaks down, I gotta call someone. Like it was just perfect. So that's a perfect example. So that's one where you've been cross-selling. There's a relationship. You go with that. The second one I would take is like a standalone, non-integrated geographic kind of acquisition in a geography where you're comfortable working with. I mean, I have great experiences, and again, this is not working with Northern European countries. When it comes to acquisitions, the Finlands of the world and the Swedens of the world and so on. And
the Scandinavians, the Vikings.
The Scandinavians, amazing. I've
seen a lot of commonalities between being out here in Canada and Northern Europe.
It's so just absolutely love it. Had one of my best acquisitions in Netherlands, for example. It just was perfect. So still standalone. The guys are running perfect operations. And then over time, we started cross-selling each other's kind of products. But it was just perfect. No, not leading with integration, not leading with synergies, quote unquote, layoffs. More like, hey, you continue doing your thing. There might be an opportunity to cross-sell this product there, but let's not. That will just happen organically, kind of a thing. So that would be my second scenario. But the first one that I told you was just perfect. It's like, just go to the sales guys. It's like, who's selling your product? That's how you build your pipeline in a corporate kind of a setting.
Very cool. When we are courting the companies, we gave example of if you had to convince somebody to sell and the right time to sell. But in almost these scenarios, we kind of covered a couple of the extreme ones, right? Here's a company we're going to dismantle and take the scraps out of. And here's one operating in a completely different geography. Is the pitch going to be different? Teach me that part. How do you pitch the deal when you're sitting down with the founder? You're kind of getting them to start thinking about selling the business, but you just got to put the sugar on it to get them excited about it. Teach me, how do you drop that sugar to get them excited about the deal?
I think you got to find out stuff that they hate, right?
So less of fighting the good, you go for the hate. What do you hate about your business?
Why would I kind of start to upsell them on stuff that they may or may not know, or the problem is M&A teams sometimes can oversell how good they are.
I do. I promise how good we're growing and in the future ahead of us. And this is a good therapy session. I'm already getting some realization of what I'm doing wrong here.
Or say what you hate. And if the stuff that you hate, and if we can take that over from you, we will be more than happy to kind of, then you become part of this. The second piece is also there's sometimes founder fatigue, right? Or investor fatigue in the company. So what you're doing is giving them an out, right? And saying, listen, you have multiple options, but we can give you an out at this point in time by becoming part of this company. And you just kind of go from there and see where that goes. But at the same time, if you're going to offer them, look at how good we are, and where you should sell to us because we're growing, then you got to show to them how they get to participate in that growth, right? So
part of the good's still there.
Yes. So maybe it's a hybrid deal. It's an upfront cash, but then they get to roll over 30% or 20% of their equity into your company so that they get the upside of that as well.
Yep.
So then we're part of the same family, right? At the end of the day, but our interests are aligned, and maybe they've been bootstrapping this for 15 years, and the guys are like, man, it's I need some exit. So you basically give them some liquidity to their shareholders, which could be them, and some of the investors, and then you bring them over as part of the upside.
So dig into what do they actually hate. And it could be some things operationally about the business. It could be founder fatigue. It could be investor fatigue as well. And then you got the plus side of here's a dream. We got a vision for the company and where you may fit in that. And then too, that you could roll over some of this value instead of just getting cash and having the tax headaches to figure out. You can actually just roll this over and become part of something even bigger at this new growth future we have.
Or in some cases, I think what happens is it's very hard to structure a hybrid deal, because then the investors say, oh, but this person's getting the upside, we're not getting the upside, and this and that. So what you can also do is you can do a hard kind of complete sale of the company, but the key employees that come over, they become part of your ESOP, the share option plan, right? Employee share option plan. So then they get to they have a new new employment agreement with their new kind of, stock options, which you would give to your senior executives or whatever level they're at. And then they get to be part of that upside. So that way you've cleaned that entity completely. And now it's part of you're bringing them over as brand new employees.
So clean out what do you call it? The trash before, not the trash, but just clean house before you.
Clean house. There's structurally, you sometimes it's good to do what they call an asset deal, for example. So that way you leave all the liabilities behind. You don't have to worry about, where the skeletons are buried. You basically are handpicking things that you want, kind of a thing. That could be, that's easier in North America. That could be more complicated in places like Europe, for example.
You ever done a deal where you hate the CEO?
Yeah,
hate the CEO. There's some investor fatigue going on. So you sort of are tempted to pull the rug under that person?
No, you can't pull the rug. I think what happens is it happens during the process, because you always walk in with the intent of doing the deal. And then you realize, man, that this guy is going to be so disruptive to our culture. And you basically have an internal discussion and say, if this person comes on board, it's going to be a disaster for us. And then at that point, you need to kind of figure out whether this deal is with or without that person.
What if they're the one trying to block the deal and the investors want to sell?
It depends on who has the control. So I'll give you a real example again. This is why it's 2 decades of lessons from the trenches. A great company, buy-side M&A, working on behalf of a company. Find a company in Spain. It's 15 years ago, so I can be a little bit more specific, still without naming the company. Really like it. The example I gave you, cross-sell stuff, all that good stuff is happening. Hey, we would like to kind of come over and see you. The company is in Madrid. Fly in Madrid, all good. Yeah, and so guys what's up? I said, listen, do you want to be part of our company? Because he's who gave you the impression that I'm selling the company? I'm okay. Sorry, this was a little bit of a misunderstanding, but listen, you have a great company. What had happened was, what a lifestyle business is? So investors invested in a company to get a certain type of return, But what happens is a venture capitalist wants to sell the company when the company is growing, right? At a 20%, 30%. And this goes back to, I got to exit when I've got very predictable 30% year over year growth, right? Like long-term contracts.
Correct.
I got to sell the company now. But what happens is, what if the company becomes like profitable, break even, and the guys are having a good time? They have no urgency to sell. But as an investor, you're like, you got to sell. No problems. We come back. Kind of like a disappointed a little bit, like got on a plane, went all the way. Then I said, wait a minute, I need to look at their cap table. Cap table has 3 VCs in it who are in this company for the last 9 years, right? Usually the venture capital model is like a 10-year fund, right? So they need to kind of wind down the fund at year 10. Usually they start the process at year 8. If you haven't exited in 7 years, like it's like, hey, what's our plan B? So now I like call the guy, look at the partner, because its partner is on the board. I've called that venture fund Barcelona. I was like, hey guys, like Amit Monga representing this company. What's up with this company? And the guy's like, do you want to buy it? I said, yeah, we want to buy it. So he's like, okay, so go and see the CEO. I said, as a matter of fact, I was there last week. And they told us to get lost. He's like, do you mind taking the flight again? It's like, yeah. He's like, you're going to fly into Barcelona. We're going to take a train to Madrid together. He made it happen. He's like, it's not your company. It's my company. So the guy was like fighting back. He's like, you know what? You've just shown to these guys that you actually are not a good fit for the company. So the VCs told us, come up with a IP transfer plan and how you're going to run this company without this team, as in like a couple people. And that's it. We basically, so this would be the most kind of hostile kind of, it's a private company. It's not like a hostile takeover of a public company, but it's like, and we're like, oops, okay, we got to put a plan together. And then you have to like be very careful. Like, hopefully they're not sabotaging things. Hopefully they're not like, we had to sign very strict non-solicit kind of, things. And then you're in a different country. So then you got to figure out like how, like North America is easy, right? You know the US laws and, Canadian laws. But like Europe, like, if they do something, what's going to happen? So you got to like go through all those scenarios. But perfect example, investor said, go, I'm with you. I said, okay. So he's like, fly here, we'll go together. And unannounced, we walked in. He said, do not tell them you're coming. I'll come with you. I was like, are you telling me you offered them? And he said, they should have informed me about this meeting. And if you're telling me that, he said, did you socialize a number with them? I said, yes. He says, what was their response? I said, they told us to get lost. He's like, okay. He said, can you put that in an email for me? Like I said, email, we'll give you a non-binding offer. How about that? He's like, let's go. I gave him the non-binding offer, subject to, right, DD and so on. He said, all right, this is good enough for me to kind of move forward.
I think a key piece was that cap table. Getting access to it gave you a full picture of who's running the show, who you need to influence, and almost like which order of people you should influence. And
then you wanted to make and then our biggest risk assessment there was you just wanted to make sure that the key customers were not, how do we manage the key customers? Because the key customers were in Europe. How do we make sure that these key customers don't go anywhere? The beauty is there weren't that many companies in this space, and for people to switch to a new technology was very hard. So
how do I get access to that cap table? Like, do I just ask one of the investors for it?
No, you can't get access to the cap table. I basically reached out to that VC because he was on the board. So I just said, hey, you're an investor in this company. We were thinking of acquiring it. So you've been in for 9 years.
Any of the investors, any investor or mainly a key investor that's a board member would be the one that would have access?
A lot of the... in a lot of the cases, there could be shareholder agreements where they say that if an exit doesn't happen, it's X number of years, they have the ability to kind of, influence that outcome kind of a thing. So So definitely, like, they do have some kind of an influence to kind of trigger the stuff. And we took care of all the employees, by the way, and it was a severance and all that kind of stuff.
Good outcome?
Good outcome. Fully integrated.
I don't know. This deal might turn out that way. You want to help me with it?
Absolutely. Anytime. Anytime.
Have you ever done a carve-out from the buy side?
Yeah. Okay. Carve out from the buy side.
Especially when it's something like proactive, when you have to shape the business case and champion it to get the board to approve it.
No, technically, no, I have not. I have unsuccessfully socialized that with big conglomerates multiple times, so it's all about unlocking value in that situation. That's what a carve-out is all about, right? Like, you are a corporate, you have a real business. Let's say, actually, there's a good example. Like, you're in a trucking business, right? Like, you basically are managing a very complicated fleet of vehicles and things like that. But you also have a proprietary software that you have built to basically run that operation. And now, can other people use that platform? But then in order for you to do that, like, you need to have a sales force to sell that kind of, scheduling software and fleet management software and so on. But if you're willing to do that, that's like pure unlocking of value in that company kind of a thing. So obviously not the fleet example, but I have approached a couple big conglomerates in back of the day saying that, have you thought of spinning this out? And unsuccessfully kind of a thing. And the reason has been they're so intertwined, like, for them to kind of say, okay, great, you can take this business out, but now where are you going to move the people? Like, complicated.
So you almost like need some kind of urgency or motion already there to latch onto versus trying to champion it from scratch.
I think the regulatory thing is like always the trigger. Like, so the regulators will say, hey, you two guys are becoming fun. You need to sell this business. So then actually there's a full-blown exercise where you actually do have the consultants and they basically say, hey, this is what you need to run it as a standalone company. You can't use 25% of Amit, who is like the group CFO, because Amit's not moving with you. So now you need to hire a full person on this side, right? You can't like model a 25% of my time on that side kind of a thing. So someone has to build a brand new model with that. Then the next piece is like technology infrastructure. Hopefully you're not intertwined. So like ERP systems, for example, like if you're going to take over 100 people, now you got to have your own ERP system, right? You can't be part of this ERP system. So things like that, like I think you almost have to kind of create a company from scratch. And I have seen carve-outs and spin-outs that have gone public as well. You actually have to, in Canada, actually, you need to show 3 years of historical financials in a prospectus. So what happens if you're carving out or spinning out? You literally have to recreate these kind of, 3 historical years of financials as if they were running as a standalone company.
It's like finding these carve-outs, almost look for indicators, like consulting firms. I just think of one that would have conflicts that come up,
yes,
conflicts of interest because they're doing audits or whatever on related company. So finding those where there's going to be likeliness of a carve-out. And then knowing that part of your business case is going to be building the missing pieces when you detach that company.
Yes.
And it's for all these fun TSAs and stuff.
Yes, and you have to, exactly. And you have to model those and also have buffers for things that you haven't thought of, kind of a thing. So, your costing of something around technology might be completely off because you won't have the scale to get the same price on this side, right? So you almost have to create like a standalone organization to kind of do that.
How do I network in to find these deals? Like I got a list right now of about 30 large companies that play in either fintech, legal tech, or some kind of like enterprise collaboration. The large companies, right? These are 5 billion plus market cap that have been around for 30 plus years. And in there is like, hey, strategy shifts or things like that. Like there could be some potential of, and some of them just done massive, merger of equals. Yes. And it's like, well, maybe there's some trash. How do I start socializing this, and what's my approach?
That's a great question. I think like if they were organized enough and if they were disciplined enough, they should go through some kind of an annual or every 2 years or 3 years exercise where it's like what's core and what's not core.
Yeah.
Or what are some of the orphan products like that are worth just spinning out kind of a thing. In that situation, they basically would
the CEO to go talk to that? Or
CFOs, I think.
How about head of corp dev?
You could talk to corp dev guys. Yeah. CFO, corp dev would be the two kind of inbounds kind of a thing. I mean, it all depends because corp dev sometimes, the reason I didn't say corp dev right away was corp dev is so focused on bringing stuff in.
Yeah.
They're not focused on like spinning things out.
I feel like they're not the first to know about it. That's for sure.
Exactly. They might have acquired a bunch of stuff. Now, as outcome of that exercise, they might say, hey, we may not need this. So I've also seen where there's been a merger, but we also know 8 months out, there's going to be spin outs, right? And at that point, you should be ready with a check and with very kind of, efficient due diligence kind of, process, and should be willing to kind of pick up the assets for cheap, because I think that's where you actually get stuff for cheap.
What's my pitch to I agree, the cheap part, because it's just a lot more work to do and more risk to take. Not as many people willing to do that. What's my pitch to the corp dev or the CFO?
That you're walking in with a fully financed deal. So a lot of times people have ideas, they want to buy it, and there's like subjective financing.
Well, I'm still in discovery. Like this is my cold pitch. I used to, when I did hospitality banking, it was, do you have any hotels for sale? ? No salutation, no signature. That was it. I used to email that out and have the highest conversion. Do you have any companies for sale? I don't think would work here. What it would be?
I think the way you do that is like, I have access to capital. I'm looking to acquire companies with these metrics, this financial profile, and would love to chat with you if there's assets that fit that profile. Recurring revenue, gross margins, this, that, easily able to carve out the customers, like, it's not, and kind of go from there. And then say like, this is not subject to financing, but of course, customary due diligence and so on. And
being really upfront. Hey, I'm looking to buy businesses, and maybe compare some industry notes with you.
And also in some cases, like, if you can also work with the bankers and say, hey, do you know someone here? Because I'm interested in this business, because I don't think they're doing anything with that business. And they would be like, yeah, let me make that call and find out.
I'm going to start paying a premium if I start tapping a banker to help put a deal together.
No, the buy side banker should be acting on your behalf.
So the buy side banker is already out there.
Yeah, and and you can
engage with them, which isn't a big hit. Like you're going to pay some fees.
You got to pay some fees. Yeah, exactly. The buy side bankers will always act on your behalf. Absolutely.
I shouldn't be trying to increase the price. Yeah,
exactly. Exactly.
Fair enough. So that's helpful in terms of getting that conversation going on a carve out. And if they got some ideas, you can really help finesse and build those and take those opportunities out. How's the negotiations? I feel like carve outs is going to be its own thing, because for the most part, they probably just want cash out. But some of these other deals, when it goes back to dealing with the founder, you mentioned rolling over equity. Is it the same play of a little bit of finding out what they want, what they're trying to do?
Yes.
If it's, what I'm trying to get at is how do you? For me, I want to preserve cash, because I can obviously reinvest it in good areas within the company. So if I can get 100% owner financing, if I can get a big chunk on the earnout or rollover equity or the combination of those three, I'd be pretty happy. How do you get to that? like the optimal structure?
Step one is, what does the core team want to do, right? Like, I mean, where are the team? Is the team motivated to move into a new company? We're talking about carve-outs now, right? So you want to make sure.
Let's play both, because we'll do carve-outs, and then let's go back to the traditional example, because I feel like that's more, what I'm looking at now. But yeah, so carve-out, you're a good question. Like, do they actually have a team that wants to move with the business?
Exactly. Are they comfortable coming into a new environment, kind of a thing, right? Like, I mean, for example, a year ago, I actually visited a company in one of the cities here, and I walked in. I'm like, there is no way there's a cultural fit. Like, it's like, yeah, like, I mean, these guys are different. The client I'm working with, the personalities and the culture is not going to gel. So I don't want to misrepresent what we're doing and all that. So then I come back and say, are you comfortable running them as standalone? I was like, no, it's really predicated on them working with this division, kind of a thing. So it's like, I don't think that's going to happen, kind of a thing. And so I told the company, listen, I think what you should be doing is you should be trying to raise capital and become an independent company, kind of a thing, rather than trying to kind of become part of another conglomerate. And that was my advice to the sell side banker. It's like, oh, Amit, I really appreciate it. Oh, by the way, do you know anyone who would be interested? Like, I said, okay, like, happy to kind of, make those intros. So that was kind of one scenario. And the second one you're saying is having these, how do you make sure that this team is comfortable in a company that you bring them into?
Well, I'm just thinking like optimal structure, right? We're going through the negotiation and putting out the financial terms together, because you always put this offer, and let's say 10 million for a simple number, saying, hey, I'm going to give you 10 million for the business. That sounds great, but I want you to take 1/3 as a financing term. I want you to put 1/3 as an earnout and 1/3 rollover equity. You cool with that?
They will need to individually evaluate all these options on a kind of, in a combination, and hopefully the sum of parts should kind of be attractive.
That's where this is the exercise. This is like, let me get all the 20 years of experience.
So I'll tell you, so it's easier if there are external investors, right? So forget your example, you're bootstrapped, right? Like there's no external investor.
I'm a pain in the ass seller.
If I'm an external investor and this is my 9th year in this company and someone's offering me a hybrid deal.
You want cash.
I want as much cash as possible because I want to close my fund.
Yeah.
Right? So I'm like, man, like front-ended with as much cash as possible. I don't have the administrative bandwidth to manage the options, right? Like, I mean, I can't, like, if you're an investor, I'd rather give you cash and close the fund rather than saying, here's the cash, by the way, but also there are options in this new company. We don't know when it's going to go public, kind of a thing. So if there's an investor piece, they would try to get as much upfront cash as possible. Let's say if it's a bootstrapped kind of thing, I would say I will need to sell them the vision of my company and what is their path to liquidity once they get ownership in your company, right? I totally buy 60 to 70% growth rate. And it's like, hey, like, I mean, I love Amit, and he was on that podcast and he said, like, you have the best product. Like, this is great. I mean, that means a lot to me. But the problem is if I'm rolling in 50% of my equity into Deal Room, I got to say, okay, like, when do I see the liquidity from the equity that I've actually rolled into your company, right? So you will need to then share your plan with them. And usually the way it works is, and I've been through those scenarios where the guys have said, let's do and there are pros and cons of that. Like, let's do an all cash deal. Okay. You do the all cash, you get the cash up front. Or people say, let's do all stock deal because I'm going to go public in 18 months. And then you get the upside from there, but you can also have the downside, right? Like not every stock is going to go up or down, kind of a thing, right? So when you're offering people stock in your company, you better be prepared to show them what is their next liquidity event based on the shares they have in your company, Because if you're saying like, I'm never going to sell, it's like, whoa, then I might as well get all my money up front.
Do you scenario that out and saying, hey, in 3 years, we're likely to have this liquidity event at this valuation?
Yes. Yep. You definitely.
So you can sell the dream.
You can sell the dream. Absolutely. I mean, it's you cannot sell it as an official offer, offer.
We're
but
not
you
signing
can
off any forward-looking statements.
Yeah, but you gotta you can say, hey, listen, hypothetically, this could be the value of the company. Even then, if I'm a seller, I would try to this should be like the gravy for me. I would like to kind of probably monetize as much as I can now, kind of a thing. But at the same time, when if the company is planning to go public in 12 to 18 months, and I'm acquiring the company, at that time, actually, the entrepreneur or the shareholders they may have a call internally and say, hey, guys, maybe we should take stock in this company because the upside is going to be huge for us, right? So I think that's the way to kind of, look at it. So if you have near-term visibility, for example, in a company, like when it comes to kind of liquidity, what you should be doing is you have the flexibility to kind of make that call.
That's I like digging into their perspective and understanding what's going to be their driver and really how can you influence them.
I think the more near-term options for liquidity, the easier it is for you to pitch equity and the stock in the company.
Yeah, I think that absolutely makes sense. Is there a certain window? Is you looking 2-3 year seems to be the right area?
Yeah, I think if you can, I think if you can show that in 2 years there's going to be a liquidity,
you would recap the business and be able to take them off.
Exactly. It's an IPO candidate, for example.
I'm a little far from IPO candidates.
No, what I'm saying is yeah, exactly.
My world, but I like where you're going.
Right.
I think that's my next aspiration. Let's do the first recap. Maybe the second one will be towards IPO.
I think frankly, if you can get everything you want as a private company, I would stay private.
Yeah, that's a good point.
Yeah, there are a lot of regulatory costs. There are, of course, significant pros to be public, but there are also cons to go public, right? There are regulatory costs and additional costs and things like that.
When do you start this game of capital allocation, right? I'm running the bootstrap business now, and we get a lot of interest to invest in the company, and it changes the whole dynamic, right? Having a board right now, it's true freedom. I can run around 100%. With my shirt off and screaming, and nobody cares. But when you do that, I get a lot of inbound interest from all different types. You got the venture capital, you got small funds, some of the bigger funds that are trying to build early pipeline. And then you have now they got these, anybody thinks they can wake up and start a fund or a search fund. But then now you see strategics actually doing these kind of minority investments, whether it's their corporate venture fund or something like that, or just directly off the balance sheet. When is the right time? Because part of it is, hey, I find this opportunity, but we're still growing. And now all of a sudden it's a little bit of a conflict of, selling off some of the equity, rolling over some equity, you start changing that whole balance to do it. I'm just curious because I feel like that's why I'm so cheap on looking at these deals.
Yep.
Just because I know hey, to get the long-term, I don't want to change that picture right now, especially in that run to get to 20 million ARR. So I'm a little bit sensitive about all that dilution you do because it is you can clearly see the impact it makes. What's your thought? I want you to say just go get a bunch of debt and call it a day.
No, if there's no urgency to take out cash, because in some cases there is that catalyst.
What's that when you need the boat or the...
Yeah, exactly. Or you really want to get that private jet kind of a thing. And
I do want the private jet, but I want the company to pay for the private jet.
Yeah, exactly. And then you can do that right now, right? You may not be able to do that once you even have a minority shareholder because they will have veto rights on expenses that are
all right. So I have to acknowledge there's a lot of freedom to give up in doing this.
Yeah, I think in your situation, I think whatever that kind of number that you want to go after, 20 million or 50 million. And we all know that the moment you go beyond some of those kind of ranges, like the valuation premiums go up significantly. You have to make that call. You're still young, you're having a good time. If there's no urgency to kind of take out cash, the only thing you have to kind of think about is like, is there going to be a product that may make your product out there? Is there a product out there that's going to make your product obsolete? Or you may lose market share. If that's the case, then you need to kind of think about it. If you are comfortable that this company is going to continue to grow at least for X number of years, then have a good time and kind of go from there. Like, looks to me it's a sticky business. It's like, you just continue to kind of add stuff. I actually would definitely think about doing acquisitions, like, in other geographies just for fun, because I think you've covered every city in North America. I think you want to start going to Paris and like Stockholm and like Oslo and Copenhagen to do some, M&A Science Podcast. I'll carry the equipment with you.
There you go.
So
there's definitely confidence on the organic growth. The dream is to do M&A. The dream is to build a business to $1 billion revenue. And it's primarily an M&A platform. And you see a lot of them out there in the public market.
I think, joking aside, Kisan, I think from my perspective, you've got a very stable, solid platform now. I think like-minded kind of, CEOs, entrepreneurs, hopefully they're bootstrapped, because what you want to do is like have like that founder to founder chat with them kind of a thing, give them some liquidity, and then bring them part of your fold and say, listen, guys, together, now we are going to the next milestone. That's our 20 million ARR. Then you do the next acquisition. Say, guys, together as a family, now we're going to 550 million ARR. And then you kind of do your math and say, listen, I think now I'm like hitting $1 billion in enterprise value. And you kind of socialize that with a couple guys and like, okay, then I think it's time to exit, right? And then you decide like whether it's a full sale or whether you just want to retire, or whether a couple of these acquisitions you did where you've groomed some of the younger folks to take over from you who can continue with your legacy, but you've also cashed out. That's the way I see it.
So I should be focused on building a platform for entrepreneurs to grow.
Yeah.
That, hey, there's
in this space. Yeah.
We're on a platform together that's allowing us to take best of and continue fostering growth.
Exactly. And the ability to share like the best practices you have on your side.
Accelerating value creation.
It's your playbook, actually. You'll start to build your playbook and see what you can cross-sell.
That's why I look, like even the European company that we're looking at, it's like we could take what we learned here in marketing and it's going to work wonders, because they don't really believe in marketing over there, which is amazing. I don't know how these companies survive and thrive, but so, okay, that's what I'm going to do. I'm going to focus on the platform for entrepreneurs. All right, so Amit, you worked on both buy and sell side, and thinking of the approach to each side, but even like the risks that you're looking into, what are your big learnings from? Like how do you sort of differentiate your focuses between the buy side and sell side?
So start with buy side because it's more because you live with it, right? So sell side is kind of very transactional, right? You're a sell side banker. Frankly, you're working with the shareholders of that company that you're trying to sell and maximize value. That's what you have to deliver. Actually, our fees are dependent on basically a percentage of the actual sale price. And obviously you hire a banker because their job is to actually identify buyers who basically will pay the premium price for it. Strategics might value you more because they like certain aspect, cross-selling and all that kind of stuff. So there, my job really is to kind of make sure that if I have an engaged buyer, I basically deliver everything they are looking for and maximize value for the shareholders of the selling asset. Simple as that. Yep. And in some cases, like, the guys we constantly need to kind of make sure is the offer that's coming to the table is a credible offer. Like, is it a funded offer? People would say, I paid this, but it's like, okay, how are you going to fund it? Oh, well, it's subject to financing. Oh, I got to check like whether these guys can raise capital or not. So in most of the cases, I want a fully financed deal and so on. So that's there you're really on the sell side, you're providing a process support. Simple as that. And your ability to anticipate any challenges. Like, so kind of say, this is too good to be true, right? Like, or if this is the potential buyer, do a quick check, who their banks are, who are their funders, and then kind of challenge them and say, listen, I know you're kind of doing this and you're saying it's a fully financed, but like, can we talk to someone like, just to kind of give us a little bit of comfort level that this will happen? Or if it's, in some cases, they might say it's subject to approval by X, Y, and Z internally, then you say, okay, I want to understand the process.
Yeah.
I want to understand. So let's, like, you know what? I understand the process. I want to whiteboard that process. You give the offer. We agree to move forward in principle. When are you going to convene the board meeting? Right? What is the resolution going to look like? Who's going to allocate money from the balance sheet? Like, all that good stuff. Like, does that impact any of your covenants with your existing facilities, right? That can happen in a kind of a very large acquisition. Oh, it's a $5 billion acquisition, but subject to, we're going to do, we're going to have a debt facility and we're going to have like subsequent bond offerings and things like that. So there's a lot of risks associated with it. So that's a sell side thing. But the buy side is actually more around like making sure that post acquisition, it actually delivers what it's supposed to deliver, right? So financial metrics given, right? Because that's Excel and that's how you basically agreed that you're going to basically, buy the company. But, is it going to basically align with the product roadmap? How are we going to cross-sell this? Like, have we talked to people who are actually going to own this business unit? If one of our theses was that we are actually going to cross-sell this in Germany because the German clients don't have that product, what is our action plan? So there's much more detail because we own it. Right. So that actually keeps the buy side people awake at night, kind of a thing. Now, if it's a if it's a completely standalone, non-integrated acquisition, right? So you're a travel company globally, and you're just buying another travel company that is like the Expedia of like, of Europe or some country in Europe, and they're just going to continue to run standalone. This is more just market share and stuff like that. It's different. But if this is something happening in North America and it's going to be integrated with us, then you better have a good sense of how you're going to actually do it. So I think that's why those things become a little bit more closer to home kind of a thing from that perspective. And you have to kind of make sure that you have a good team that can do the integration. Not to forget, people just take for granted like the IT systems, right? Like the IT systems are so important. Like, do we have the right IT systems? Like, like if you're going to integrate, like which ERP is going to go where, and those could be huge costs. Security, for example, right? Like, is there a security kind of, do we have the right kind of security framework? Because that could impact our insurances and things like that as well. So buy side, in my opinion, a lot of emphasis on post-acquisition kind of, I would say issues and points.
It's all about diligence. When you're on the sell side, you're doing a lot of diligence in your buyers, filtering out bad actors, pressure testing them to make sure they got certainty they're going to get the deal done and be the right buyer. When it's on the buy side, then it's very specific to your strategy. What's the value you're trying to drive from the company? And that will probably help you prioritize where you're going to focus on. And you're really getting a lot more people involved because you're covering all the different aspects of the company, from the people side to the IT and the finances and et cetera. Again, different weights depending on the deal itself. Does that sound about right?
That's absolutely right. Absolutely. You nailed it. Yes.
People always see me taking notes. I'm like, I do this for a reason. He's like, why is he always writing stuff down? I'm like, I'm trying to remember this stuff. So surprises, like, are there other, I'm just curious, this is like where we try to have a little fun with this, but just you've done diligent. You're smiling because I know you know this. What kind of surprises have you encountered? Buy side, sell side, diligence, integration?
I think for example, there was a period of non-compete and people quitting exactly on the day when their kind of, their employment agreements, had their non-compete had expired, for example, and things like that. I think, I don't want to say, I think the only one I've seen is where the acquisition just didn't make sense because the market shifted. You acquired a company because you thought you actually were going to cross-sell something, but then that market just disappeared all of a sudden. Without going into specifics, you acquired a whole bunch of internet, you acquired an internet company because you thought you could cross-sell them content. And that just didn't happen because people just went to content somewhere else, kind of a thing. And your whole thesis was based on cross-selling that. So
do you see that as a reason to kill the deal?
Well, the thing is, the deal had to be written off at the end of the day.
Oh, so the deal was done, but then you had to write off the whole value.
Yeah, exactly. It became too strategic, if you will.
Yeah, it was
that was hey, we need this because we can cross-sell this because our market here is saturated. We need to basically now go and sell this we need to acquire another company so that we can cross-sell them our product. And now let's pay them as if it's cost of customer acquisition kind of a thing. So,
yeah.
But
that's a not good integration surprise.
Yeah, no, and I'm just trying to think nothing massively kind of, crazy, because I would say the M&A over time has become also very, I think very sophisticated and more disciplined now. I think there were days back in the day, AOL, Time Warner type kind of acquisitions. I think the more you see now today is there is a very well thought through rationale for doing things, right? You may pay to acquire AI talent, right? People said why would you pay $1.6 billion if that was a number for YouTube? Now look at the amount of ad revenues YouTube is generating, right? It's incredible kind of a thing. And there were so many things that people said. There were so many reasons not to do that deal. Yeah. Copyright infringements and how are you going to monetize the content, things like that. What if how are you going to manage all the bad content, how are you going to moderate that content? There were so many reasons, but they did it. And then here we are, right? And those are examples of deals that made sense. But then you also had AOL, Time Warner, where it's the best content company in the world, selling kind of, and monetizing the internet kind of, users, but it just didn't kind of happen, right? But I think the world of M&A in the last 2 decades, maybe that's a great way to kind of summarize some of our conversation. I'm super impressed with how sophisticated the pieces are. I think it's great to see how M&A is actually a core function of a lot of the organizations. It might not be a corporate development department, but there is someone who probably is responsible to monitor acquisitions, to monitor targets, and so on. And even at the private equity level now, they're investing in having a resource in their fund to just monitor, for example, potential targets, for example, for their portfolio companies. So I think it's becoming more and more I would say, sophisticated when it comes to kind of, dealing with different players across the table. People have investment banking background, people have product background, people have sales background, people have senior management. There are some founders in some cases who are now running M&A for larger companies because they kind of understand how their roadmap works, product roadmap works. So I think it's good to kind of see that how you see all these kind of, a very diverse complementary skill sets that are kind of representing M&A. Back in the day, it was like, hey, you're a finance guy. You basically understand how to work spreadsheets, but it's definitely multi-dimensional now.
Yeah, I think you're right. Just overall, I've seen it doing this podcast. You and I, first thing I mentioned about your background.
Yes.
Just you're seeing the M&A change. It's not go to Ivy League school and become an investment banker.
Yes.
It's a whole different, and it needs it. It definitely needs it because everything we talk about is all around putting diverse set of skills together.
The best M&A, buy-side M&A I did was one of the companies. The internal team was like myself working with the CTO and head of product. With the CTO, I said, put the product roadmap and show me where the gaps are. And we'll do buy versus build scenarios.
Wow.
And then we just kind of, executed on that.
That's pretty cool.
So here you are, all of them were like non-finance people. I mean, I would consider myself as a finance person given like all the M&A I've done, but I was basically, my core team was non-finance.
So that's, I like that because it really helps you focus on what's going to really drive value and solving.
And the buy-in as well, right? Like after you acquire, it basically fits in their product roadmap kind of.
Those are the ones that are going to have to lead integration, at least the key elements of what's going to create value. What are the trends you've seen around? Like we talked a lot about different strategies, but how have you seen this trending otherwise since you've been in the field?
So I would say,
I think of like the 80s, the big takeover. It's all like break the big sum of the pieces or pure cash flow and that's it. Like things are really changing.
I think things are becoming more and more strategic. I think things are becoming way more aligned with corporate strategy, in my opinion. I think, of course, there are one-offs all the time. There will be triggers like, there is a breakup of a big conglomerate, like, this piece is for sale. Are you interested? But I find like in majority of the M&A strategies we're seeing, the corp dev teams are very aligned in terms of what is their short-term, medium-term, long-term strategy. This is our growth plan. This is our organic strategy. This is our inorganic piece. Let's see how we can execute it. I'm very impressed with, I think the companies that are doing well or have a very good handle on their corp dev initiatives. And a lot of those guys are, like, for example, on M&A Science that you talk to, I think you can relate to a lot of that because they're very organized, like, the PayPals of the world and, the booking example, right? Like Carta, for example, they know what pieces they want and they're not shy to kind of sometimes take that risk, right? Oh, this is a great functionality. Would love to kind of offer that to our existing clients because otherwise they're going somewhere else. And so they're making those bets. The second thing that I'm seeing is slowly people who have money on their balance sheet, they have strong balance sheets, they're willing to do minority stakes in the targets, potential targets. Pros and cons, obviously. Cons for the people who are taking the money is like, hopefully they don't become like, tied to this company now. Hopefully they can still have the flexibility to sell it to someone. But I'm finding more and more the banks are interested in investing in companies, in fintechs of the world, or companies like Salesforce, companies like Microsoft, companies like Google. They have their own venture funds, and they are taking positions in these companies. Companies like Thomson Reuters, for example, have a venture capital arm. They basically are identifying opportunities that are, they might not be a target today because venture capital, too early to buy, but hey, I can invest 10 million, 20 million, 30 million, kind of not a big number for that big company, but I get to be part of the upside, and hopefully they can benefit from this partnership. So I'm finding like the M&A, actually, this is actually should be a good quote. M&A is like, back in the day, the 80s and the 90s was very transactional. Like if you said M&A is like you and I wearing suits, boom, Hermes ties, boom, 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 white shirt, transaction. M&A now is like building relationships, kind of like multi-pronged approach, being part of, like, of course, you're still doing transactions, but like also engaging with the innovation ecosystem. And eventually they may acquire the company, but you know, it's much more kind of like less transactional now.
Yeah, it's like you're looking at strategies from different angles and taking bets against them as well.
Exactly.
That's my big takeaway today. It's don't be too opportunistic and much of a bargain hunter. You got to keep your strategy focused.
And think like medium term, long term, right? Like, I mean, and having that shareholder value. But at the same time, if someone puts a deal in front of you, be ready to act on it. And that's where, you know, the stuff you and I talked about, the playbook comes handy, the muscle memory comes handy, the ability to pull together that team comes handy, and kind of go from there.
So one important thing I got to ask you, what's the craziest thing you've seen in M&A?
It's like you keep on coming. People not doing, like, I mean, there was one deal where they weren't negotiating in good faith, kind of a thing. They would just they just walked away at the last minute. And there was a lot of time and effort that was put into the deal. The
buyers or sellers walked?
The seller.
The seller walked at the end. But that's got to be some personal stuff going on.
Yeah, changed their mind. They thought like they had much more runway. And then they came back 2 years later because they couldn't execute on their strategy. The investors wanted an out. And at that time, like the management team said, no, we're never going to work with this guy, period.
Then
so that was, it was personal.
Yeah.
Like it was personal.
It depends on what side you on and what outcome. You know, I've had one not too long ago, reminds me of, where, look, didn't want to see a good outcome for them. That's what ended up happening.
Yeah. Like it's sad, but like, I mean, it is what it is, right? Like, I mean, I think, they just kind of said, no, I think I just want more. And, which was not.
There's another old saying. It's like, if you get a good offer, you should probably take it.
Yeah. It's, and there was a lot of time invested in it. I was personally involved in that company, kind of a thing. I brought in the PE player. We had agreed on, if it was a public company, we had agreed on a share price, kind of a thing. And that was the best offer. And I said, no, I'm not going to do it. So
you think it's just ego? Like, hey, we could do better. We can grow this. And
yeah, but in the end, like they did not get that. Right. Like,
you're coming back with.
So like, I mean, you know, as I kind of went back to the same, PE fund, and, you know, it's a big fund. It's a mega fund now. And that person actually was a VP at that time. And now he's actually the CEO of that fund. And we still chuckle and said, remember that day? Like, it was 2005. I still remember it. I'm like, are you kidding me? You just like, this is like, what are we talking here? It's like, no, I've changed my mind.
I said, the P firm was on the sell side.
This P was on this buy side.
On the buy? Oh, so that was you were working with the
yes,
buy.
Yeah.
That's funny. I was going to say, let's put them on the podcast.
Yeah, exactly. So anyways, it's all good. Like in the end, like, you know, a lot of lessons kind of learned and stuff like that. I mean, I also have like another interesting story is where someone at the height of the .com bubble, and that's not my personal deal, so I will not take credit for that, but I've heard the story and it is a true story. Someone offered a price, and we're talking like bubble valuations. And the lawyers were sending the terminal fax, to a wrong fax machine. So when the seller or the target didn't respond for 2 hours, they thought that they had offended them and sent another fax with like a premium of another 10-20% to it. But it was just going to a wrong fax number. So in the end, they ended up paying like 70% more than what they were supposed to, because they thought like the other person was saying like, this is I'm offended by this offer. And so anyways, that's another story where
now that's crazy.
That is the craziest story ever. And it comes from a very credible person. He was at one point a billionaire. And he tells me that story all the time. It's a mentor. And and he's like, Amit, it was just going to a wrong fax machine. You know, like how you are like, you do these agreements and like you put this generic fax number, which could be like your head office somewhere, but you're expecting the fax to come to the CEO's personal fax machine because it's like confidential. And for some reason, this was not being sent to that number because an associate somewhere basically said, okay, this is the number. So in the morning, they said like, hey, like, where's the offer? He said, oh, but we have sent it and this is the number. And the guy's like, oh, all right. Yeah, there must be some problem with the fax machine. Why don't you send it to this fax machine? It's like signed it right away.
Wow.
Here's the story for you.
Wow. I mean, this has been a fun conversation. Thank you so much for taking the time, helping me become a better M&A scientist.
No, listen, I think you're doing an amazing job. I think I'm learning so much also from your podcast. And most importantly, I was able to get you a wonderful weather in Toronto for this trip.
Made it happen.
Can't believe that was the case. So, but anyways,
made it happen. You're the tipping point. I kept threatening to come to Toronto this year, and you were the tipping point to actually make it happen. So thank you for doing that. Looking forward to hanging out for the week. Fellow M&A scientists, if you've made it through this interview, I appreciate you. Love to hear from you. Reach out to me. Tell me what you thought of this interview. Any feedback. I welcome the criticism. I'm trying to get good at doing this. Ideas are welcome as well. Till next time, here's to the deal. Thank you for joining us for part 2 of our conversation with Dr. Amit Monga. From corporate M&A playbooks to valuation trends and carve-outs, this series was packed with actionable advice. Visit mascience.com for more resources and follow us on LinkedIn for the latest insights. Thank you, Amit, and thank you to our listeners. Until next time, keep pushing forward on your M&A journey.